Hello, I'm Mark Kenny with Think Multifamily. We specialize in apartment investing. We focus on typically 100 plus unit property sizes. We have investors that invest alongside with us, and we teach other people how to syndicate, which is just a fancy word for raising money from other people so you can go bigger faster. If you want more information, click on the link below, and there's more information on our website. But today we're going to focus on the 5 key points you need to look at before you invest in apartment investing, and we'll give you more detail, but this is going to be a summary today. So cap rate is probably one of the most confusing topics for people that are new to multifamily investing. You have to think about an apartment complex. Typically 5 units and above is considered a business by an investor and also by the lender. They look at it as a business and they're going to value it based on your net operating income. That's just your revenue minus your expenses, so net operating income. And then they're going to say, what will somebody pay for a property if they paid cash for it? That means that's the cap rate. So cap rate is not just for multifamily, it's for other investments. What's the rate of return on an annual basis if you paid cash for it, which most people don't pay. The market cap rate, and there are other terms as well related to cap rate, is what are people paying in that particular market? And then you also have something where you look at other properties that have sold in that same submarket for the same type of property, age-wise, same classification of property, same demographics, and that will be used to help value the property. It's very similar to a multiple on a stock. So you might pay $1 for a property, and then someone of value, and people are going to say, I'm going to give you $10 for every dollar you have of revenue. So it's a multiple on that $1. It's important to know and be aware of cap rate and what it really means for a value. If you think about a 5 cap, you don't have to get confused as far as terminology, but a 5 cap is going to be $20 of value for every dollar. So let's say, for example, I only had $1 of revenue, right? Well, my net operating income would be, let's say, $1 in that case. And if I times that by 20, it means an investor is going to give me $20 for every dollar that I have of basically your net operating income. So if you're off on that, if you can look at it and say, well, what happens if I evaluate a deal and I'm off, $10,000? Well, you're not off $10,000 valuing it. Now you're off $200,000 of value. So it works both ways. It can also work to your benefit if you're going to do a refinance or a sale. This is really how people have made a substantial amount of money by selling properties that are multifamily or doing refinances and using that cap rate to help exponentially increase the value of the property. So I've done 119 deals as a general partner, made more than 1 or 2 mistakes, maybe a couple hundred, a few hundred, a few thousand. I don't know, a lot of mistakes, right? But I've learned a lot. I'd say some of the most common mistake people I see make are initially, people don't involve the right people to help get the information they need to evaluate a deal. As an example, your property taxes are a huge expense line item on your pro forma analysis that you do. You better make sure you engage professional. Insurance costs have been sky high across lots of parts of the country. You better make sure you have an insurance expert involved giving you a quote there. Mortgage rates, everyone knows, are kind of crazy all over the place. The amount of money that lenders will give you is down substantially, and rates are up substantially, like double of what they were, a year ago. So you need to make sure you engage those people to help gather all the information to make an informed decision. Outside of that, the biggest mistakes I see is only giving one property management company budget as an example. A property management company will operate the deal after you close, and they're going to give you some sort of projection budget for revenue and expenses. You better make sure you get more than one so you can compare that. The other mistake we see is people being too aggressive on things like, I'm going to implement, it's called RUBS, which is billing back for utilities. That's just what it's called, is RUBS. I'm going to have charge for pets. I'm going to have valet trash. I'm going to have solar. I'm going to have, you name it. And if those things all have to be there in order for your deal to work, I'd say you're probably being too aggressive. One of the other major things the guy asked me the other day, as far as one of the biggest mistakes that I've made, and I think a lot of people have made investing, is being undercapitalized. So if you've ever done something like a renovation on a house, which we're going through right now, and our budget's about 3 times what it was when we started, which is not uncommon. But reality is, if you're buying a business, you're going to have CapEx you're going to do, which is going to be improving the property. Chances are you're going to spend more than you think you're going to spend, and it's going to take more time. On top of that, you also have to typically pay for all of that before you get reimbursed from a lender. So even if a lender says, I'm going to give you $3 million for capital improvements, you have to spend typically hundreds of thousands of dollars, pay the vendors, and then ask the lender to pay you back. And they take their old sweet time. We've had examples where it's been 5 to 6 months to get reimbursed. So a big mistake, in my personal opinion, is being undercapitalized. Raise more money within reason. And if you have it there, you can always give it back if you don't need it. But those are probably some of the biggest reasons I've seen people make mistakes. And there are a lot of other ones. We go through a lot more detail on this through our website. We have training videos on it. We also do a workshop where we spend 3 days together going through deals, hands-on with the computer, walking through real deals and mistakes that we've made and other people have made as well. And the whole intent is to help you prevent you from making mistakes that we've made that could save you typically hundreds of thousands, in some cases maybe millions of dollars of value. So sub-market cap rate is really what other people are paying in the market for that property. So if you think of a multifamily investment, 5 units and above, it's treated as a business. And as part of that business, there's going to be something called the net operating income, which is your revenue minus your expenses, excluding your mortgage. That's a number. And you say, okay, well, what does that mean? You take that number and then you're going to divide it by what's called the cap rate. The cap rate for the submarket is what other properties that are similar to the property you're looking at buying have sold for in that market. And if you do that, let's say it's a 5 cap, you're going to take $100,000 divided by 5%, and that's going to give you what your value for that property or what the price should be for that property. It can vary over time, which it will, based on what's going on in the market, whether interest rates are going up, going down, what's going on during COVID, it changed a little bit. World events can change that, and then just each property is a little bit different depending on where it's located. You can have the exact same net operating income in California that you would have, let's say, for example, in Michigan, where I grew up, Detroit-ish area, and the property values can be drastically different, even though both, in this case, properties or businesses are producing the exact same net operating income. The values can be drastically different based on where it's located, the vintage or the age of the property, the demographics, and things like that. Yeah, we're in a pretty dynamic market right now. We've seen interest rates go sky high. We've seen loan proceeds being reduced, in some cases being cut. The rent increases we've also seen go very high. So historically, rents have kept up and or surpassed inflation. Right now, I'd say it's very, very dynamic across the country as far as increasing rents or not being able to increase rents. We have certain properties, just for example, in Dallas, we're continuing to increase rents even with the inflation going sky high. We have some other properties across the country where we're not able to increase rents as much. So historically, if you look at it, places in like the Dallases or Jacksonville, Florida, places like that, we've gone, 10 to 20% rent increases. So you never want to underwrite a deal assuming that. You're basically getting lucky. You didn't control it. You're just a function of the market being favorable for you. Historically, it's been 2 to 3% in a lot of markets for rent growth. Even that, in some markets, you might have to cut it down a little bit. I don't have a crystal ball. No one else does either. But what I would say is look at what the current property is performing at and compare it to other properties in the market. We're not really typically seeing rent cuts right now. That's not to say that we won't. There could be something called like a concession. A concession is basically giving somebody a reduction, usually like maybe their 3rd month is free or 13th month is free, those type of things. But right now I would stick to, the 2-ish% rent increases. And in some markets, you might even have to decrease that and assume there's no rent increase for the first year or so. It's a cycle. Things will change. Rents will go up. We know they do. We look back over time. property values will go up. I don't know when it will happen, so right now I'd be extra conservative on your rent increases, and then also be more conservative on the amount of money that you're actually going to hold in your capital reserves to help cover any issues you have, either mortgage shortages or things like that. I've invested in a lot of different areas. Multifamily is my favorite. Some of the main reasons I've done it, and other people do it as well. The tax benefits can be great. Depending on where you are, you do get tax break. Now, whether you take that your first year or in the future, we haven't paid any federal income taxes since 2016, like zero, and that's all through multifamily investing, and we make money, so we're able to offset that. We are real estate professionals, which is kind of a different topic, which we'll talk about other videos. But the whole thing is you get depreciation benefit allocated to you, so tax, hopefully savings. We have a lot of examples of people pay zero in our group. You also get typically high leverage from a lender. It's non-recourse debt, meaning we don't have personal liability if something happens. The lender, yes, they could take the property, but they can't come after us personally. And then one of the biggest things is once you scale, you can get like a professional management company in there to manage, so you're not being responsible for changing, toilets in and out and things like that. So there's some of the main reasons. And then one of the biggest things, which we talked about during this video, is the cap rate and how that can exponentially increase the value of a property, more so than any other investment I've ever seen. That wraps it up. Thank you for listening to these 5 key points. We do have more information. You can go to our website and then also leave comments down below. We're more than happy to try to respond back to you.